Well, I'm sure you've heard about the big bill that was just signed into law on July 4th, and it's a doozy. It's close to 900 pages long, and there's a lot of stuff in it. But in this video, I want to separate all of the politics and opinions and just take an objective look at the things that are in this bill that's going to affect your personal income tax return. And you need to know these things because some of it is retroactive to January 1st of this year, and then some of the provisions start next year. Also, some of the changes are permanent and some of them are temporary. So let's get right into this and see how this bill is going to affect your tax return. Now, the first thing I want to talk about is the tax brackets, because back in late 2017, we had what was called the Tax Cut and Jobs Act that went into effect January of 2018. Now, that was set to expire at the end of this year. These are the tax brackets that we have been under since 2018. That bill back then lowered the tax brackets. If it was going to expire, if it was left to expire at the end of this year, most people's tax brackets would have gone up. So the 10% tax bracket would have remained the same. The 12% tax bracket would have jumped up to 15%, 22 to 25, the 24 up to 28, the 32 to 33, the 35% tax bracket would have remained the same, and the highest tax bracket of 37 would have jumped up to 39.6. Okay, so that's what would have happened if, that bill would have expired at the end of this year. So these now are made permanent. Okay, so these are the tax brackets that we are now under. Now, what kind of incomes are for those tax brackets? Okay, so when you're looking at these amounts here, this is your taxable income after your deductions. So after any standard deductions or maybe you itemize, okay? So if your taxable income, let's say for a single person, would fall between 0 and 11,925, that portion of it would be taxed at 10%, double that for married filing jointly. Okay, and you can see the 12% tax brackets, okay? So over that amount and less than 49,475 for a single person, that amount is taxed at 12%, double that for married. And you can go ahead and look at these. Okay, you can pause the video and take a look at those. But these are now, these 7 categories are now permanent. Naturally, these amounts will be adjusted up for inflation slightly every year. Okay, now, also back in 2018, that bill actually more or less doubled the standard deduction. So if nothing would have been done this year, we kind of would have reverted back to the other amount. And of course, it would have been indexed. So from the Tax Foundation, they estimated that if the Tax Cut and Jobs Act would have expired, for a single filer, your standard deduction would have been $8,350, joint filer $16,700. Okay, so now this new bill sets the standard deduction for single person at $15,750 for this year, and married filing jointly $31,500. You can see head of household here. These were also made permanent, and going forward, these will now be indexed for inflation, so they will go up slightly every year. Okay, now there's an added benefit to seniors, people 65 and older. There was a lot of talk about no taxation on Social Security. That did not get in the bill. But I guess this was somewhat of a compromise. So in 2025, first of all, a single person, 65 and older, gets to claim an extra $2,000 over and above the standard deduction, and married couples $3,200. Now, so you still get this, but there's an enhanced deduction only for the next 4 years. So starting this year and going through 2028, where you get to claim an additional $6,000 over and above this, over and above your standard deduction. Okay. So again, that's only good for the next 4 years. It does start to phase out. This enhanced $6,000 deduction starts to phase out if your adjusted gross income is $75,000 or more for a single filer and $150,000 for joint filers. Okay, now Back in 2018, that bill actually did then also double the child tax credit from $1,000 to $2,000. So this was also made permanent and increased slightly to $2,200. And then going forward, it will also be adjusted for inflation starting in 2026. So this is a benefit that very high income earners do not get. Okay, so these are now locked in, the phase out caps. So the current child tax credit income phase out limits are locked in for good. $200,000 for single filers, $400,000 for married couples filing jointly. After that, it starts phasing out, and at some point, it just goes away. So very high income or over these thresholds, okay, this isn't really a benefit. Okay, taxation on tips. Before I go over this one, let me just take a quick moment and say I'd really appreciate it if you could hit that like button. Maybe leave some comments below of what you think of the information in the video. And it really does help the algorithm, and I'd really appreciate it. So thank you. Okay, taxation on tips. Again, this is temporary for the next 4 years, 2025 through 2028. Tips you earn may qualify for above the line deduction of up to $25,000. Now, what does above the line mean? It means that you don't have to itemize to take this deduction. So you can still just use the standard deduction, which was quite high, and you don't have to itemize. You can still claim this, okay? People that use the standard deduction, it really simplifies your tax return and makes things a little easier. Now, the deduction starts to phase out once your modified adjusted gross income hits $150,000 for single filers or $300,000 for joint filers. You must have a Social Security number. Your employer will need to indicate your total cash tips and qualifying occupation on your W-2 form. Now, again, all of these things that we're talking about affect your federal tax return. Notice that any earned income is still going to be subject to Social Security tax and Medicare tax and any state and local taxes that you may have. Okay. The other thing you'll notice is that all of these things kind of start phasing out at some point for high income earners. Okay, so taxation on overtime, again, this is temporary for the next 4 years. You may qualify again for an above the line. You don't have to itemize to take this. On overtime wages, you'll need a valid Social Security number. The deduction is capped at $12,500 each year if you file as single, and $25,000 if you're married filing jointly. The deduction starts to phase out once your modified adjusted gross income hits $150,000 for a single person and $300,000 for joint filers. Again, your employer will need to include the total qualified overtime compensation separately on your W-2. Again, Social Security and Medicare taxes still apply in any state and local taxes. SALT deduction. Now, the SALT stands for state and local taxes. So typically you can take your state and local taxes, and that's a tax deduction on your federal tax return. But back in 2018, those were capped at $10,000. Well, this bill raises the cap from $10,000 to $40,000. Again, this is temporary for the next 5 years, 2025 through the end of 2029. Then it's going to revert back to the $10,000 in 2030. There is a phase out period with this also. It begins to phase out with a modified adjusted gross income of $500,000, regardless of whether you're single or filing jointly, or $250,000 if you are married filing separately. It phases out, keeps going down until it hits that floor of $10,000, so you'll always get that amount. The SALT cap will also increase annually for inflation through 2029, giving taxpayers a little extra wiggle room, if your local taxes go up. Beginning in 2030, the cap will revert back to $10,000, of course, unless new legislation is passed. If you itemize, okay, this is a deduction where you have to itemize to use this. If you itemize the deduction and live in a high tax state, This change means you could deduct more of your local taxes for the next several years if you fall under the income thresholds. Car loan interest deduction. Now, again, temporary. For the next 4 years, starting this year, you may claim an above the line, you don't have to itemize, deduction of up to $10,000 for the interest paid on a qualifying passenger vehicle. I hope you're not paying that much interest on an auto loan, but the deduction starts to phase out if your modified adjusted gross income is over $100,000 for a single filer and $200,000 for joint filers. It must be a car, minivan, SUV, truck, van. Motorcycles do actually qualify. It must be a new vehicle, not used, and its final assembly must take place in the United States. It doesn't mean that all the parts come from the United States. It doesn't mean that it's completely built here, but the final assembly must be here. It must have a valid vehicle identification number, of course, and things like campers and RVs don't qualify. Okay, savings account for children. Okay, sometimes these are, I guess, referred to as Trump accounts. The savings account, called a Trump account, that provides a one-time contribution from the federal government of $1,000. Again, this is temporary for the next 4 years. The child must be a U.S. citizen. The parent or guardian must have a Social Security number. There is no $1,000 seed for children born before 2025, but accounts can still be opened if the child is under the age of 18. Annual contributions can be made after that of $5,000 per year. They can be made by the parent, family members, so like grandparents, or even your employer if you have an employer willing to do that. Now, the employer portion of that $5,000 is capped at $2,500. Contributions are after-tax dollars, made with after-tax dollars, so there's no deduction for that. But the investments grow tax-free while it's growing. Funds must be in a low-cost mutual fund or ETF that mimics the broad U.S. stock market, so think of the S&P 500. At the age of 18, the beneficiary can begin using these funds only for qualified expenses, things like education, first-time home buyer, starting a business, and a few other minor things. Non-qualified withdrawals will be subject to a 10% penalty. Now, there's also, remember, the contributions are not deductible. So as you pull money out, part of that will be your own contributions, and part of that will be the earnings or the profit that those investments made. Your contributions are not taxed, but the earnings are taxed as ordinary income. So other than the contribution, these accounts are taxed pretty much just like a traditional IRA. Okay, there's a few other things. Charitable contributions. For people that don't itemize, it's a little easier now because there's an above-the-line deduction of up to $1,000 for a single filer and $2,000 for married filing jointly for qualified charitable contributions. Other minor changes, it's a bit more flexible eligibility rules and qualified spending for an HSA account. And there's some expanded qualified uses for 529 plans. So you can take a look at those. Also, the estate tax provision. Back in 2008, that was roughly basically doubled. Okay, so those are now permanent and they're going to be indexed going forward. So permanently increase the estate and lifetime gift tax exemption to an inflation index, $15 million for a single filer and $30 million for joint filers. Okay, now, naturally, there's a lot of other things in this bill. It's a huge bill. A lot of things I didn't even touch on. I only tried to focus on the things that are going to affect people's individual personal income tax return. So I hope you found this helpful. Please hit the like button and leave me some comments below. Thank you for watching.